Welcome to the Deep Dive. Today we are cracking open Heineken Holding N.V. We're diving into their Q3 2025 trading update and the management call from October 22nd. It really gives us a great look at how a huge global brewer is, well, trying to handle some pretty intense global volatility.
Absolutely. And that's our mission, right? Tight through the noise, figure out what's really going on behind those volume declines. Where did their strategy actually pay off? And is that full year profit guidance? Is it solid or maybe a bit optimistic? We'll be looking closely at net revenue BIA. That's before exceptional items and amortization. It's their key measure for the underlying trend.
Okay, let's jump straight to the results snapshot because it really lays out the tension they faced. Net revenue BIA for Q3 came in at $7,327 million. Organically, that was actually down slightly year over year, minus 0.3%. Year to date, they're just barely positive, plus 1.3%.
But yeah, the real story is under that revenue number. Beer volume was down 4.3% organically for the quarter. That's a pretty significant drop. Even premium beer volume, which you'd expect to hold up better, was down 2.2%. And the main Heineken brand itself, down 0.6%. I mean, with a volume miss like that, you'd almost expect them to cut guidance, maybe pretty sharply.
Right. And that's exactly why the market reaction was what it was, because management actually maintained its full year 2025 organic operating profit guidance. They didn't raise it, mind you, but they reaffirmed growth. They did narrow it, though, to the low end of that original 4% to 8% range.
Yeah, it felt like a relief rally. The market seemed braced for worse news. So getting results that were basically no worse than expected, well, it led to that muted positive reaction. Shares were up a bit, over 1%. Investors took that intact guidance as a sign, I think, that management believes their internal levers, price, mix, cost savings, are strong enough to absorb that volume shock. At least that's management's view.
Okay, so let's unpack those internal levers. Because, this is where the financial juggling happens, right? How do you absorb a volume hit like that and still protect your profit outlook? It seems to come down to price and cost. Net revenue per hectoliter was up 3.6%. That's quite healthy.
It is, and that was mostly driven by a 3.3% positive price mix effect. About 2.3% of that was just pure pricing, passing on inflation. And the other 1% came from positive mix, people buying more premium stuff where they could. But the real foundation here, the thing holding it all together, seems to be the cost side. Management said they have very high confidence in hitting $0.5 billion in gross cost savings for 2025. That's crucial.
$500 million in savings. It sounds a bit like high-stakes gambling, though, doesn't it? You're banking on those cuts to offset the volume deleverage hitting your fixed costs. How much wiggle room does that actually leave them if Q4 volumes don't bounce back as much as they hope?
That's exactly the risk investors are weighing now. It's the core tension. If they nail that euro 0.5 billion target, yeah, they can probably hold the guidance. But if they miss it, or if volumes somehow weaken again, well, they've kind of used up their buffer, haven't they? Management's whole narrative right now is the volume issue is external, macro-driven, but the efficiency gains, those are internal, under our control.
So let's talk about where that volume pain actually came from. Management blamed, the usual suspects, macroeconomic volatility, weak consumer sentiment, particularly hitting the Americas and Europe. But what's interesting is how their global strategy kind of saved the quarter.
Absolutely. This wasn't a uniform global slump for Heineken. It was very much a Western markets issue. Their strategy, investing more resilient, developing regions, it really paid off here. Strong results in Africa and Asia helped cushion the blow from the weaker regions we'll get to.
Yeah, Africa Middle East saw net revenue jump 14.9% organically. That's huge. They mentioned Ethiopia specifically, over 50% revenue growth there, driven by the local Har brand.
And Asia was another real bright spot, especially for premium. Vietnam saw the main Heineken brand grow almost 40%. And maybe more strategically important long-term, their licensed volumes in China, Heineken Silver, Amstel, grew in the mid-20s. Strong numbers. It really shows this divergence, Premiumization steaming ahead in Asia while Western markets are getting more price sensitive.
Okay, now let's pivot to the problem areas, the regions giving them the headache. Starting with the Americas. This region got hit hard. Beer volume down 7.4% organically, revenue down 5.5%. Where was the worst of it?
Well, the big drag was Brazil. Shipment volume there contracted mid-teens. Ouch. Management blamed retailer inventory adjustments. Apparently there was a price hike on July 1st. They were careful to point out that sellout data, what consumers actually bought, looked better than the sell-in numbers to distributors, suggesting it was more of a stocking issue than a collapse in demand.
But how confident can they really be that that inventory issue is truly sorted by the end of September? We've seen supply chain wobbles before. Could they be a bit too optimistic about Q4 shipments normalizing fully?
That's the key question for the Americas, definitely. They say they're confident, but yeah, the risk of another surprise is there. We saw a similar story, though maybe less severe, in the US. Shipment volume down mid-teens there too, also blamed on distributor stocks. But you have to give them credit for one thing in the US. Heineken 0.0. That non-alcoholic beer just keeps growing. 24 straight quarters of growth based on depletion data. It's a real bright spot, showing that some strategic bets are working even when the core market struggles.
Okay, shifting over to Europe, the picture there was messy too. Organic volume down 4.7%. And here it felt like a mix of headwinds, economic, regulatory, and even some operational friction.
Yeah, the operational friction was quite specific. They had those long-running retail negotiations, pricing disputes in places like France, Netherlands, Germany. They got resolved early in the quarter, but the recovery, the restocking by retailers, was slower than they expected. Management reckons about a third of the European volume drop was purely down to that slow restocking. They expect that bit to be fixed by year-end.
All right, so 1/3 might be temporary, but what about the other 2/3? That sounds more structural. Like Poland, where the whole beer market is down mid to high single digits, and Heineken's actually losing share on top of that. And then Austria, wow, that new can deposit scheme apparently caused the can market to just plummet, like 30–40% initially. That's a huge hit to demand.
Exactly. It just highlights how tough navigating mature markets can be right now. You've got the macro weakness, you're fighting for share, and you're dealing with these sudden regulatory shocks, all while trying to cut costs and push through price increases. It's complex.
So with all this market-by-market craziness, risk management has to be key. How are they adapting?
Well, they talked about evolving their approach. Moving beyond simple forecasts, focusing more on leading economic indicators, things like remittances, small business funding trends in specific markets, and developing clearer scenario plans, plan A, plan B, plan C, depending on how bad the macro gets.
And yet, despite all that caution, they still seem pretty bullish long-term. They're arguing the America's weakness is cyclical, not structural. Pointing to good underlying trends like population growth, premiumization's still happening. And importantly, they say they're still gaining share in key growth markets like Mexico and Brazil, even with the Q3 noise.
But with inflation still sticky and rates high globally, how sure can they be it is just cyclical? Especially in the West, where you see consumers maybe trading down or just buying less discretionary stuff. It feels like they're relying quite heavily on hitting those cost savings while they wait for a macro recovery that, well, who knows how long that takes.
Yeah, although their actions speak volumes too. They're actively buying back shares. That multi-tranche program, up to $1.5 billion, with over $500 million already done by mid-October, that signals some confidence, returning capital even now. And this whole Q3 update really just set the stage for their capital markets event, which is happening right after the call. Investors are definitely looking for more detail there on costs, hedges, the multi-year plan.
Absolutely. The core tension hasn't gone away. Investors are worried about volume. Management is betting on cost control and premiumization in select markets to hold the line on margins.
Agreed. And that tension sets us up perfectly for our final segment.
This is not financial advice.
So hit us with an outrageous but plausible trade idea based on what we've heard.
Okay, so the market seemed maybe a little complacent. It celebrated the fact that OP guidance wasn't cut, even with that big 4.3% organic volume drop. This puts enormous pressure on two things working out perfectly in Q4, hitting the full $0.5 billion in cost savings and seeing much better elasticity, meaning volumes bouncing back strongly as pricing maybe eases a bit.
So the idea is the market's underestimating how sticky that volume decline might be.
Exactly. So the trade idea, a tactical short on HEAO, the holding company shares, the bet is that the combination of European distribution issues resolving slower than hoped, plus that underlying softness in places like Poland and maybe the US. It just means the Q4 volume bounce needed to hit, even the low end of guidance doesn't quite happen. That volume deleverage could then force them to officially cut or abandon the 4–8% range altogether early next year. The current price arguably doesn't fully reflect that risk.
That's definitely playing on the Q3 volume gap. Okay, so to wrap up our deep dive, Heineken got through a tough Q3 using price, mix, and those crucial cost savings to offset big volume hits in the Americas and Europe. They managed to keep the profit forecast alive, but only just at the low end.
And my final provocative thought for you is this. Management sounded pretty sure the Brazil inventory mess is fixed, setting up the Americas for a better Q4. Okay, if that operational fix is truly done, does the risk now shift almost entirely to the macro picture in the US and Western Europe? Could a worsening environment there still overwhelm any Brazil bounce? Are they maybe over-reliant on that America's recovery when the bigger storm clouds are gathering over their mature markets?
That's definitely the key risk management challenge for the rest of 2025. They've addressed the known issue, but the macro unknowns linger. Thanks for joining us for this deep dive. And just a reminder, everything we've discussed today is for informational purposes only. It is not investment advice. Happy tracking.